Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Fall webinar series. This program is entitled Retiring in Israel, Tax and Estate Planning Considerations. For those who don't know me, my name is Jonathan Shenkman, and I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Bloomberg, CNBC, Fortune, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, U.S. News and World Report, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One more quick note before I introduce our esteemed speaker, and that is that the handout to this program was sent out within the reminder email this morning. It will also be sent out again in the follow-up email tomorrow morning as well. Today, we're privileged to hear from Boaz Feinberg, who's a partner and the head of the tax practice at Tadmor Levy based in Tel Aviv. Boaz has nearly 2 decades of experience in taxation and financial regulation on both administrative, regulative levels, as well as in litigation. In the areas of domestic and international tax law, Boaz specializes in advising and acting on behalf of corporations and high net worth individuals. He also provides advice and tax planning on mergers and acquisitions and other complex international transactions. In the field of civil law, Boaz advises various trusts throughout their establishment and ongoing activities, advises and represents clients before the Israeli tax authorities and various judicial instances, including in the Israeli Voluntary Disclosure Program. Today, Boaz will be speaking on retiring in Israel, tax and estate planning considerations. And with that introduction, I'll now turn the program over to Boaz.
So thank you very much for the warm introduction, Jonathan. And it's always a pleasure to participate in your very, very professional webinars. And hello, everybody. One note I wanted to make, Jonathan said I'm from Tadmor Levy. Now it's only half true because a few months ago, our law firm merged with Yigal Arnon law firm in Israel, and we are currently the third largest law firm in Israel. Servicing major companies, both domestic and foreign, and naturally with many tax issues, with me focusing on corporate tax, but also mainly on individual taxation, specifically relating to immigration, trust and estates, and real estate. And so Jonathan asked me if I can speak for the next 30 minutes on retiring in Israel. For those of you who live in the United States, this is not really an issue for 30 minutes. I have to tell you, this is something that we can talk about for many, many weeks. So I'll give you a primer on the very vast number of issues that you need to take into consideration when you do so. I have to also tell you that it really does depend. When you say retiring in Israel, it really comes down to the specific nuances of each retirement. It could be someone who's retiring when he's already 70 years old. It could be someone who had an exit and he's from high tech and he's 40, but he wants to continue on to work. It could also be someone who is retiring after his children already made aliyah and he's coming to live near the grandchildren, which is something that we see quite a bit here in Israel and always makes us happy. But that is, his tax treatment would be fairly different than the person who's coming in to be the first person in his family to make aliyah, to become an Israeli resident. And so you really need to look into the specific nuances when you decide to do the move and to come live in Israel. We will run swiftly through the agenda. We'll be discussing in short on the 10-year tax holiday for Olim, which is still in existence and hopefully will continue on to be in existence, although we do hear the tax authorities from time to time claim that they want to amend the existing treatment. We will discuss shortly the planned reform as to residency and exit tax, which now, after yesterday, we're probably going to have a stable coalition and a stable government, and we will probably see more legislation being passed now that we have running government. And that also concerns planned reform in real estate taxation. We will discuss shortly taxation of trust, specifically with regard to a Supreme Court ruling that was provided a few months ago relating to real estate taxation and trusts. We will talk about wills and durable power of attorneys, and end with taxation on pensions. Legal infrastructure. Basically, in Israel, you have two major sets of rules. One is the income tax ordinance, which deals with income tax, corporate tax, and trusts. And then you have the land tax law, which deals with the taxation of real estate in Israel. With regard to the 10-year tax holiday, current situation, anyone who makes aliyah, becomes an Israeli resident for the first time, will enjoy a 10-year tax holiday on his foreign sourced income, which means any income that was derived outside Israel and would be passive in nature, but also on business income. Business income, though, you need to be aware that that would be under the 10-year tax holiday, provided that the business income was derived and generated outside Israel, meaning that anyone who is retiring from one job in the United States and wishes to continue working from Israel, even if it is for a US company or entity, if he stays in Israel while he is working, then Israel would tax him on the business income. And that is opposed to passive income, for example, dividends or interest or capital gain for sales of assets, which those in the next first 10 years of his immigration would be tax-free. And the exemption also applies not only to the actual payment of taxes, but also applies to the reporting on any assets or income that is generated outside Israel. And that, again, for the first 10 years of living in Israel. The question of whether you are a resident of Israel or not is something that is now under current reform. The situation currently today is based on a material test of center of life. Center of life, of course, is a number of indicators as to where you actually live. It would include your place of your permanent residency. It would include the place where most of your family interests, your economical interests, your social interests are, and that would accumulate to the center of life test. And that is with an additional refutable presumption relating to the number of days that you spend in Israel. You may spend more than the time indicated and still claim that you are not an Israeli resident, even though it is not an easy claim to make, and vice versa. Tax authorities may claim that you're an Israeli resident, even if you stay below the number of days. So today, there are currently two presumption of days. One is spending 183 days in Israel during a tax year. A tax year is from January to December. And that is one indicator. And the other one would be spending 30 days in Israel and spending, together with the consecutive 2 years prior to the tax year in examination, a total number of 425 days. And if you reach that number, then you are presumed to be an Israeli resident. The tax authorities, as I indicated, wish to reform and amend the existing test, claiming that the existing test is ambiguous. It sets room for tax planning and sometimes tax evasion, people who spend most of their time here and would claim that they're not Israeli residents because their center of life is not in Israel. And so they want to make the number of days test to be an irrefutable presumption. They are dealing with several possibilities, and we'll wait to see what would be the final legislation. And currently, they are talking about having a person who is present 183 days in 2 consecutive years as being irrefutably an Israeli resident, and another number of days which would become irrefutable is if you spend 100 days or more in a tax year and your spouse is in Israel. And this is particularly important for someone who is retiring, and many times couples, the wife or the husband are retiring, they want to spend time with the grandchildren, and the spouse wants to continue on to work. And then the question would be, what happens if one person is now living in Israel and they have a house here and they spend time with the children and grandchildren, and the other spouse is on the line? They spend some of the time in Israel and some of the time continuing on to work in the United States. So if the reform is passed, then you will have to take into consideration the number 100, which is the number of days that would be either you are irrefutably an Israeli resident, and if you spend less than 100 days in the tax year, then you may be an Israeli resident or may not. That will remain something that may be refuted by both the tax authorities and the taxpayer. And so this is one thing that is very important for people who are considering retiring. When you have one person in the family who is retiring and the other one would continue on to work, that needs to be taken into consideration. Another thing that needs to be known is a reform relating to exit tax. And this is, of course, with regard to people who came to Israel and then decided that they want to leave. So first of all, a reminder, as long as that is still the law, you have the 10-year tax holiday, and that means that if you leave Israel before the end of the 10 years, then you would basically will not be taxed on an exit tax on any assets that you own outside Israel. Naturally, that will not be the case with regard to assets in Israel. And so currently the exit tax is a fairly liberal mechanism in which you're allowed to defer the taxes paid upon exiting Israel only upon the actual sale of the assets in the future. That, of course, caused mainly for not recording the actual sales by the taxpayers when they're no longer under the Israeli eye and the tax net. And in that respect, I will just give you one thing that is important to understand. Unlike in the United States, where you as a US citizen would continue on to file tax returns to the United States, even though you're no longer actually living in the United States, in Israel, like most countries in the world, once you leave Israel and are no longer an Israeli resident, and provided that you have no income in Israel, then you are not obligated to file any kind of tax return to the Israeli government. And so many taxpayers who left Israel and were supposed to pay the exit tax upon actual sale of assets that happened after they already left simply did not file any tax returns and did not pay the tax. And so the reform wants to have you pay either as a deemed sale based on the market value when you leave the country, or to have a deferral route, but that is only with regard to specific assets. For example, it may be true to private equity. With regard to publicly traded shares or security, there will be no deferral and you will have to pay the taxes upon leaving the country. And so that will be the reform. Israel will now have the ability to tax upon the exit tax if people leave the country. One other reform that is important to realize, and again, we had elections and we are probably having a stable government, and those reforms are, we're waiting for the government to pass them through the parliament. And the other reform is real estate with regard to foreign residents. Currently, most of the time with regard to capital gain on sale of assets in Israel. Foreign residents and Israeli residents have the same treatment, other than one caveat relating to a sale of a first apartment. A sale of a first apartment in Israel, meaning the only apartment you own, would be tax-free up to a value of 4 million shekels, which is more or less $1.2 million. And if you have only one apartment and do not own additional apartments in Israel, then you will be eligible for that exemption. And the same applies even if you are a foreign resident, provided that you do not have a residential apartment in the country of residence. So if you have no apartment owned by you in the country of residence, and you have only one apartment in Israel, then you are eligible for the exemption. Another exemption is a linear defense on any kind of spread or appreciation from the date of purchase of the real estate in Israel and all the way up to December of 31st, 2013. That spread would be tax-free, and the remaining value or appreciation would be taxed at a 25% tax rate. And that is applicable to both Israelis and non-Israeli landowners. This again would, the government wishes to change that so that foreign residents would not enjoy the lineal defense, and only Israeli residents will be able to enjoy the lineal defense. They are allowing, under the reform, to have people sell their apartments until January of 2024, applicable to the existing law. And after January 2024, they would move into the reform, and then anyone who is a foreign resident holding real estate in Israel that was purchased a long time ago, he again would not be eligible for the lineal defense, and he would have to pay taxes on the entire spread. Taxation of trusts, again, talking about taxation of trust in a very short time we have is not much. I will say that taxation of trust is one of the more complicated issues that tax experts in Israel have to deal with, those who understand it. One thing that you need to realize is to be aware of the multinationality of trust, meaning once you have a situation where either the settler or the creator of the trust, the funder of the trust, is in one jurisdiction and beneficiaries are in another jurisdiction, then you have to start dealing with issues relating to Israeli taxes. It could be either the grantors in Israel and the beneficiaries are in Israel, and vice versa. The grantor now immigrated to Israel and he has beneficiaries either both in Israel and abroad. All those kinds of trusts are classified in a manner that can absolutely cause tax accidents that you need to be aware of and need to consult before you make the move of immigrating to Israel or having a beneficiary related to you immigrate to Israel. One thing that is important to note is a few months ago, Supreme Court decision in Israel made it very difficult for those who are using trust to plan estate tax with regard to real estate in Israel. And the issue was whether or not a trust in Israel would be considered a separate entity from the creator or the beneficiaries for tax purposes. And so under the income tax ordinance, which deals with income tax, it is very clear that the trust for itself is a different entity than the grantor or creator and the beneficiaries. But under the real estate tax law, it wasn't clear whether or not the trust should be classified as a separate entity for tax or not. The tax authority's position, which the Supreme Court asserted, was that the trust is disregarded for tax purposes, for real estate tax purposes, And that means that any type of transfer of a piece of real estate in Israel that is held by the grantor into a trust, that would be deemed as a transfer of the real estate to the beneficiaries of the trust. And so for those of you who are familiar with planning estate tax using trusts, irrevocable trusts, discretionary trusts, and so on, you probably know that it is practically the same situation in the United States, where you pay gift tax upon the transfer of the asset into the trust. And so from that perspective, the transfer of the asset from the grantor into the Israeli trust with beneficiaries in it would be considered a sale of the asset into from the grantor to the beneficiaries, and that would cause at least a payment of purchase tax in the hands of the beneficiaries. The other problem that it causes in Israel is that any kind of change in the identity of the beneficiaries may cause additional tax effects, right? Because if there is no trust and the trust is disregarded, and there are specific beneficiaries who are the original beneficiaries, who are the owners of the property, anytime that there is a change in the identity of the beneficiaries would be seen as if there was a part of the real estate that was sold to the new beneficiary. And so there are issues to be dealt with relating to this and thinking about planning. And we are, in our office, are thinking about solutions for this problem. One solution that we're considering is using wills that would be prepared by the beneficiaries. Just a reminder, in Israel, there is no estate or inheritance or gift tax. And therefore, perhaps we can use a will mechanism to make sure that any change in the identity of the beneficiaries would not be considered sale of the real estate. As to wills, and this is not a tax issue, this is actually relating to inheritance. And so with regard to wills and inheritance, the general rule, if there is no will, there is in an intestate inheritance, the general rule is that the estate is divided 50-50, 50% goes to the remaining spouse, and the other 50% go to the lineal descendants of the person who passed away. And if there is a will, no major limitations on testator's wishes under a will. The person who is preparing the will, the owner of the assets, may have any type of beneficiary become a beneficiary of his estate. It could be next of kin. He can decide that children will not be part of the will. He can decide to, of course, give it to charity. Whatever he wants to do, the law does not prevent him. And one other thing that should be noted with regard to wills is the mutual will mechanism, which allows for a couple to have a mutual will in which they both agree that the inheritors, the ultimate inheritors of their estate, would be their children. And it allows for a mechanism in which when one of the couple passes away, the other person, the remaining spouse, must inherit the assets that were given to him after the passing of the first spouse. He is obligated to inherit, to pass away those assets to the children, and the children have a good claim against him if he decides to make a new will, prepare a new will after the first spouse passed away. So that is the mechanism of the mutual will. With regard to durable power of attorneys, fairly new in Israel. I know that in the United States, this is something that has been along for quite a long time. In Israel, a few years ago, the durable power of attorney was presented, and it allows for a person to determine who would take care of his matters and make decisions on his behalf in the event that he becomes incapacitated, both on financial issues and health issues. It must be prepared by a lawyer who was certified specifically to prepare a durable power of attorney. by the Israeli Bar Association. Certain issues, of course, the person who has the authority cannot do without the intervention of the court. For example, sale of real estate, any kind of gift or transfer of funds that exceed 100,000 shekels, approximately $35,000. But of course, this tool is being used, and it's of course a very important tool, not to allow or to have the court interfere with a situation where there's one person who's incapacitated and his spouse may be the person who would take care of him or the children. Lastly, taxation of pensions. Section 9C to the Israeli tax ordinance provides, and only with regard to pensions and benefits that were accumulated from employment or from business or from work in the United States, those the law stipulates specifically that with regard to new immigrants, Israel would not tax you on a higher tax rate and on a different event or different time frame other than the way that you would have been taxed if you were remaining living in the United States. So for example, if you have an IRA and you get taxed in the United States only upon the actual sale and getting money from the pension, Israel will not tax you on the ongoing income and probably won't tax you on the actual sale, because the United States, in our mind, has the first right to tax you upon the distribution of money from the pension. And so Israel will not be able to tax you. And this is applicable not only for the first 10 years of your life in Israel, this is applicable for the entire time you live in Israel if you were an immigrant and became an immigrant for the first time. One thing that needs to be taken into consideration, this, as I said, applies only to employment-based pensions or business. For example, if there is an inheritance of an IRA and a child gets an IRA from his parent who worked for the money that is now in the pension, his right to the same treatment does not exist, and he would have to pay very similar to a PFIC, if any one of you know what that is. It's something that usually Americans have to deal with in Israel. Israel would want to tax the level of the actual sales that are occurring in the pension fund, and not only upon actual distributions made to the taxpayers. So you need to be very aware of that. And usually we recommend children who received as an inheritance IRAs to dismantle, to wind up the IRAs so that they will not be in a position where they now need to pay taxes on deemed sales that occur inside the fund. That's about it. I think my half hour is done. I want to thank all of you for joining us. As Jonathan indicated, we will be in New York in November, at the end of November, between the 28th and the 30th of November. We'll be very happy to meet anyone who wishes to either get together and discuss professional matters. We'll be very happy to do so. And I want to thank you again, Jonathan, for having me. It's been great.
Great. Thanks so much, Boaz. Again, if anybody has any follow-up questions or any other issues they'd like to discuss, feel free to reach out to Boaz or myself where appropriate. I'll be sure to include his email in the follow-up email tomorrow morning. Again, as Boaz mentioned, he'll be in New York at the very end of November. So if you want to set up an in-person meeting, feel free to contact him directly about that. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my fall webinar series continues on Thursday, November 29th featuring Staniel Ruckelman and Neha Rastogi, both from the law firm Ruckelman based in New York. They'll be speaking on the topic, your client received a foreign gift but filed Form 3520 late, how to respond to the 25% penalty. I'll send out an invitation to this and all of my upcoming webinars after the program. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. Finally, if you or a colleague would like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can sign up for my free monthly newsletter. Simply email me with the word newsletter in the subject line. You can also follow me on social media at Twitter, YouTube, and Instagram. My handle is @ShenkmanOnMoney. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.